Hi, everybody. Thank you for joining today. My name is Juan Deshawn. I'm with Quest Trust Company. I have here Adam Barr today. We're expecting a great presentation on the solo 401k. Adam and I are going to have basically a chit chat, answering some questions. You guys are free to engage. We actually encourage that you guys engage. We also have Nicole Baker on the chat box to help you guys out, or also to filter out some of the questions and see which ones we get answered throughout our time here. We have about 200 people joining on. So as we see that number continuously increase, again, thank you guys for joining. If you're just joining on right now, we're going to show a quick commercial. And once that commercial stops, we'll get right into the meat of the presentation for you guys. So hang tight. Talk soon.
My goodness, another crazy day at the stock market. With all this uncertainty, how on earth am I going to feel comfortable retiring? There has to be a better way to invest my money safely.
There is.
Who said that?
The disembodied voice in your kitchen.
Oh my! Wait, what other way is there?
It's something called a self-directed IRA.
A self-directed IRA?
Yes.
Well, what does it do then, huh?
This IRA allows you to use your 401k and IRA money to invest in alternative assets, such as real estate, notes, and private entities. The stock market can be volatile, and having alternative investments that you are knowledgeable about in your IRA provides a lot less fluctuation and helps diversify your portfolio, so you don't have all your eggs in one basket.
Well, that sounds like a swell idea. How do I get one of those?
All you have to do to get started is open up an IRA with Quest Trust Company. You can call one of our certified IRA specialists at 855-FUN-IRAs and submit an application online now.
How grand! I think I'll call them right now.
But wait, there's more.
There's more.
Don't get burned by the stock market this summer. When you open an account with Quest Trust Company, we'll send you a free toaster. That's right. When you open an account right now with Quest Trust Company, you will get a free toaster. Use promo code TOASTER, right? And call 855-FUN-IRAs and talk to a certified IRA specialist right now.
All right. I don't think you've ever seen that before. Yeah, but guys, we're doing a little unique promotion this month, actually a few months now, where we give you a free toaster. Not even kidding. We have a bunch of them in our office. So, guys, I want to quickly, right before we get into our conversation here, I also want to share with you guys kind of just upkeep. Thank you guys for joining. We have more people joining on right now, about 200 of y'all today. Let me share my screen fairly quickly here, and we'll get right into it. So again, you guys are joining Self-Directed IRA Saturday. Quest Trust Company does a lot of these educations throughout the week. This is just one of the many things that we do, free education we provide y'all. Or we're bringing in experts in different fields or speaking on topics ourselves, IRA related. Today, we're going to be touching on the solo 401k. This is a hugely sought out account. We get questions about it every single day. And a lot of the questions, we can't necessarily answer them. I'm not a CPA, I'm not a financial advisor, but I was telling Adam, our speaker here today, that when I get those kinds of questions and I say, oh, I can't give that kind of advice, I send them to Adam, right? He gets a lot of people just from my way. So we actually are honored to have him spending this Saturday with us for an hour here to answer our questions. Real quickly, if this is your first time, who is Quest Trust Company? We're a self-directed IRA custodian, probably the largest in Texas. We have 20,000 clients, $2 billion under management, and about 100 employees. So we're a very small company, but 34 of those or so, it's always growing, are certified IRA service professionals, which just means we're just a bunch of nerds that like IRAs. We have about $350 million undirected cash, which means there's always people looking for deals. And disclaimer, again, as I mentioned, I'm not a CPA, a financial advisor, or attorney, right? So our clients have our QTC client portal. If you're a client of ours and you have not set this up, please do. It's an experience that will change the way you do your investments. You can submit fair market evaluations. We have secure message center, pay expenses for your assets. If you guys are not taking advantage of your client portal and you are a client of ours, you are missing out. Other education that we have, that Nicole Bako is going to be throwing in the chat box for you guys to check out, our virtual happy hours. We have our YouTube channel. Our education center has kind of recorded webinars for you guys to watch. Our weekly webinars are Tuesdays and Thursdays at 12 p.m. Central. And of course, we have them every Saturday at 12 p.m. unless otherwise canceled for holidays and such. So just keep a lookout on that. Go to our website and you'll see all of that. I'm running through these events because I want to get into the meat of this presentation. In July, we have our summer intensive, right? A 3-day event course on July 16th, July 23rd, and July 30th, completely online, where you can go ahead and learn from different experts in the field of real estate in general on different topics like wholesaling, flipping homes, promissory notes, etc. Just kind of learning and fine tuning those skills. So check it out. It's a very, very cheap ticket, $25. And again, as we mentioned, you get a free toaster for any account that you open up with Quest Trust Company. We literally will send you a toaster. It looks just like that. It works perfectly. We've used it a few times already. If you're a client of ours and you have any friends interested and you refer people, you can refer unlimited amounts of people to us and we'll give you credit towards your account fees. At $25 per person, you can invite anybody, right? So you can actually rack up those points there. And again, how to get in touch with us. So we have our chat, we have our phone call, and we have our email line. So that's right there. If you guys have any questions after this presentation, you can feel free to ask for that. You can watch the recording of this presentation as well on our Facebook page. The chat live, by the way, is not where you're speaking to someone across the world at a different time zone. You're speaking to one of us during our work business hours. And if it's something that we can't answer over a chat box, we'll give you a call. And again, our email line is iraspecialist@questtrust.com. We try to provide that world-class service, or we'll respond as quickly as possible. And you can just get in touch with us by scanning that barcode right there and immediately schedule a consultation with one of us. All right. So Adam, I'm going to stop sharing here. Thank you for joining us today. Adam, why don't you tell everybody here a little bit about yourself?
Great. Juan, thanks for having me. I'm excited to be here and to chat with you and everybody in the group here. Before I introduce myself, I want to say that commercial was really cute. And it's the first time I'd seen it. It's totally adorable. And while I was watching it, I thought to myself, our office here doesn't have a toaster. So that's food for thought.
We'll send you one.
All right.
We'll write that down.
So my name's Adam Barr, as Juan said. I work with a local CPA firm here in Houston, Texas. It's called MGA LLP. We're located here in the Heights off of north of I-10 off Shepherd and 6th. You may have heard of MKT Heights. It's a brand new development here, a real cool place, and it's got the coolest CPA firm in Houston in it. As far as what I do, I'm a tax professional here at the firm. I work with my clients on tax compliance, tax planning, and various business consulting and planning questions. A lot of my clients are small business owners, and I work with their businesses, and I work with them on their tax matters. Of course, I also work with a lot of real estate investors with respect to the taxation of their investments. And then finally, the way I met the folks at Quest is I also work on UBTI issues, unrelated business taxable income, Form 990T, and various things of that nature. So whether you have an issue with UBTI or you have your own small business and you want to talk to someone about it, those are all things that I can definitely help with. So that's kind of what I do. Yeah.
And guys, this presentation, this conversation we're going to have is kind of, I would say, a little bit higher level, right? We're not going to be discussing kind of the basics of IRA accounts. However, feel free to ask them. We'll definitely answer those questions. But we are going to be touching on one of the plans called a solo 401k. At Quest, we're plan document providers. We're individuals who provide solo 401ks for you, but really we're just giving you that piece of paper that creates the entity. And a solo 401k is a 401k account that you can have if you're a self-employed individual, but there's a lot of things that you should be aware of because now you're taking on this huge responsibility. So that's what we're going to ask Adam here a few questions about. We'll probably touch on the UBIT or UBTI as well. And because 401k, surprisingly, has an exemption to a specific piece of it. So we'll touch on that. But again, guys, if anything, catches your eye, you want a quick question, clarification, we encourage engagement. We want to answer all the questions possible throughout the hour. We have them here. So let's start off basic, real simple. What's a solo 401k? How would you describe it?
Oh, yeah. So a solo 401k is basically just a retirement plan that you set up for one person, or it can be one person plus that person's spouse. And that's usually going to be the owner of a small business. So, a lot of people are familiar with a 401k in an employment context, like they've worked a company job before they had a 401k. Solo 401k is basically the same thing, except for it's just for you and or you and your spouse. And basically you control everything related to the plan.
Yeah, exactly. I mean, it's like, I call it like the mini 401k. It's created to copy the 401k that everyone's heard about that you get at your corporate job, right? And it just basically gives you the same, I guess, gets you the same opportunity.
Yeah, it gives self-employed people the same opportunity for the tax deferral and the other benefits of having a solo 401k.
Yeah. One of the biggest things also, so at Quest, we always ask a person like, hey, are you self-employed? And someone may say yes. Someone may say, I don't know. What does that mean? Or, yeah, I mean, I don't have a job. I work for myself. I kind of provide my own income. What qualifies someone as self-employed? Just start real basic. How do you know if you're doing a quick little check in your head, how do you know you're self-employed?
Yeah, I actually get this question a lot too. So in order to be eligible to establish and operate a solo 401k, you really have to have a for-profit business activity that serves as the business sponsoring the plan. And this can either be a sole proprietorship, which is a business that doesn't have an entity form, or it can be an entity. Usually it would be a pass-through entity for most of my clients. So, I mean, at the end of the day, what you really need is self-employment income. So you're working as an independent contractor, or you have self-employment income allocated from a pass-through business. And a lot of folks ask me, well, does rental income count? And the answer is no. Rental income is generally not ever considered to be earned income or self-employment income outside of some very, very specific circumstances. So likely not. You really need to have some sort of operating business that you are involved with.
Yeah. You mentioned sole proprietorship. I mean, because you put it perfectly. I mean, you have an entity or you don't have an entity, that's a sole proprietor, or you don't have like the LLC, that's your employer. So like me, Juan Deshawn, can employ Juan Deshawn, right? I speak a sole proprietor. If I got that right?
Sorry, what was the question?
If Juan Deshawn employs Juan Deshawn, I'm considered a sole proprietor. If I'm, for example, a realtor or something like that.
Yeah, for sure.
So a realtor could potentially have a solo 401k?
Yeah, definitely. Because a realtor's income is often in the form of independent contractor, like commissions from whoever they're working for. Yeah, awesome. Definitely.
Yeah, and then I see a really question here. Jorge, thank you for asking that question. Guys, please, I see some other ones in the Q&A box. We'll get to them. Is a solo 401k the same as an IRA?
Oh, the same as an IRA? No. They're created by two entirely different sections of the tax code. And while they share a lot of similarities with respect to their tax deferral characteristics, you put money in, you get a deduction on your tax return. They are not the same thing. The contribution limits are quite a bit different. And as I think we'll get into later, the rules regarding UDFI are also very different. So they're not the same thing, but they function similarly from a tax deferral perspective. Yeah,
I mean, is it safe to say that they're both cars, but one of them has more bells and whistles than the other?
Sure, yeah, you could put it that way, yeah.
Right, because I mean, both of them are for the purpose of why do we have those in the first place? Why did the IRS create that? Well, for retirement, right? So they both serve a similar purpose, but they have completely different ways that they get managed, things that they can do, and advantages. And I guess some advantages over IRAs or one another. So as you said, they're completely different, but the same goal, same end goal, right? Same reason why you want them.
Sure thing.
Got a bunch of other questions here. Let's see. Oh, this one's a good one. So can cattle ranching qualify? You ever heard of that before? Can cattle ranching qualify as, I'm assuming, self-employment income?
Yeah, definitely. If you materially participate in the activity, which basically means you spend a significant amount of time working in that activity, right. And, really needs to probably be making money, right? Because if you're not making any money, then you're not going to have any basis for making a contribution to the solo 401k.
So before we get to other questions, that's a big thing too. I get that a lot. Individuals sometimes want to set up a solo 401k because they're told that, whatever event it is, that you need this account. It has a lot of benefits. But if there's someone just getting started off, it's probably not a recommendable account because you probably need to first start off creating the income. The way I think of it is you don't want to put the cart in front of the horse, right? You want to get your business started. You want to be creating yourself income and having that profit. And then set up an employer plan for you. Does that make sense?
Yeah, I totally agree with you. There's not really much point in having a solo 401k if you don't have, self income like profit, right?
Yeah, right.
Yeah.
Kevin, just to clarify, I'm a self-employed and currently loan money through my Quest self-directed IRA. So, Kevin, we would probably need more information. Loaning funds through an IRA account is not providing you income, and that wouldn't qualify you for having a solo 401k. But you mentioned you're self-employed, so maybe what you do there, possibly, I would say. Right. Tim Maloney here. Would interest earned from making loans to rehabbers from a taxable account qualifies earned income?
That's a good question. It really depends on your status. If you are in the trade or business of lending money, and that interest income is considered to be ordinary income and not investment income, depending on the way that you have that activity structured, it could end up being earned income. But I feel from the tone of the question that this person probably does this on the side as sort of an investment activity, and it's not what they're spending all of their time doing. And so it likely would not qualify in this case. But right, if that's all you do, and that's a business you work in, a pretty good amount of the time, then it could potentially, yeah.
Yeah, you probably guessed that correctly, because the follow-up was, if not, how do you kind of, I guess, switch it to where it can? But I think you answered that question in what you said. The question of flying. Can a spouse open a solo 401k based on their partner's Schedule C job?
Sorry, read it to me one more time. I didn't quite catch it.
No worries. Can a spouse open a solo 401k based on their partner's Schedule C job?
I don't know why you would do it that way. So I think the literal answer to that question is no, but I think that the question is a little bit off. If my spouse has a Schedule C business and it's earning a profit, my spouse can set up a solo 401k and be a participant in it. I, as the spouse, even though I don't have self-employment income, I can also participate in the solo 401k if I'm receiving compensation from the business. So if I, as the spouse, am being paid from my spouse's business, then I can also be part of that solo 401k. So it's called a solo 401k, but really it's a retirement plan for one person, the owner of the business, and or one person and that person's spouse, if that spouse is paid a salary from the business. Does that make sense, Juan?
Yeah, no, it makes sense to me. As you want to basically establish the plan under, I guess, the individual who has the income. Makes sense, right? No,
for sure. Yeah, that's how you would do it.
There's a question here. So Selena says, could you pay yourself if that would, I think there's a little typo here, would it give your pass through a loss? I don't quite catch that question, Selena. If you could rephrase that real quick, we'll get.
I think I know what she means. And hi, Selena. I haven't talked to you in a while. So if I have a pass-through entity like a partnership or an S corp, and that entity is paying me a salary, or excuse me, it need to be an S corp in this case, because a partner can't receive a salary from a partnership. But if I have an S corp, which is a pass-through entity, and it's paying me a salary as an employee, and that creates a loss in the business, then that's okay. It doesn't disqualify me from contributing to a solo 401k established under the company based on my W-2 wages being paid from the company. I think that answers your question, Selena, but you can always reach out to me later if you want further clarification on that.
Awesome, thank you. Yeah, so there's basically a bunch of questions here on qualifying with the income, and I think we touched on that a little bit. I want to get to different topics as well, the 401k, and we'll answer some of those questions as we move forward.
Sure.
Yeah, but so obviously let's kind of take a little step back a little bit and talk about why the 401k's contributions are better and all that stuff, how they kind of function. I think with that, we can even dive into how someone can consider reporting or keeping track of those contributions, because I feel like that can get people very, very confused. And especially when you're taking control of your own 401k plan, not having maybe a CPA behind helping you out, you can get very, very confused on what contributions you're making, how to make them, and if you're even doing that correctly. Do you have any insight on that?
Yeah, no, I got quite a few thoughts on that. So when you have a solo 401k and you want to contribute to that solo 401k, you're actually making contributions to the retirement plan wearing two different hats. You have your hat as the employee, or as the, we'll call it the employee of the business, and you also have your hat as the employer. And so, again, if we kind of take this comparison back to thinking about what it's like to be part of a 401k at just a regular company where you'd get a W-2 and you just work a regular job, you can defer part of your salary into the 401k. And that basically reduces the taxable amount of your wages, and that money goes into the 401k. That contribution is currently limited to, I believe it's $19,500 for 2021, plus an additional $6,500 if you're over age 50. So that's the employee portion of the contribution. In addition to that, the employer can also make a employer side contribution, sort of like a profit sharing contribution to your solo 401k on your behalf. That calculation differs depending on how the entity is structured. So that's something you'd probably want to talk to a CPA about, and maybe the calculation of that might be outside of the scope of today's presentation. But suffice it to say, you make some deferral contribution as the employee, and then the business as the employer will also make a contribution on your behalf. Well, that's optional, right? So, with respect to record keeping, I do have your questions list, and it looks like we were going to talk about that in more detail later, or we can talk about it now. It's up to you.
Let's knock it out, because I mean, you touched on, like, okay, obviously we have both sides. That can get complicated, and it sounds very basic, but where are these funds going to? Obviously going to the 401k, but what does that really mean? How do you know where it's going?
Yeah, I mean, you have to have the account established, and a lot of times when it's a salary deferral, depending on if you have a payroll provider, you would tell them, okay, I'm deferring X dollars from every paycheck into my 401k. Here's the info for the account for my 401k, and then they would make that transfer. If you don't have a payroll provider in place, then very likely you're just writing a check to the 401k plan, and I guess that goes to Quest as not the administrator, but the place where the plan is held. With respect to actually, keeping records and determining the amount of the contribution, and making sure that all the bookkeeping and stuff is taken care of, in a solo 401k, by default, it is the responsibility of the account holder, which is the person establishing the 401k. They can, and often do, hire a plan administrator to assist with those types of tasks. Last I recall, Quest does not offer that service. We don't either, but if somebody was in need of that service, I do believe I have potentially some referrals for outside plan administrators that can help with that.
Yeah, actually, I would love those referrals as well, because Quest does not do that part, and we get that question a whole lot. I mean, just like one of the questions in the chat box, how do you track contributions between employee and employer? And like you mentioned, if you don't have a third party doing that for you and keeping track of all those funds, it can get fairly complicated. I feel like, and correct me if I'm wrong, but I feel like you could potentially just, if you're good at it yourself, keep everything trackable. Could you do it like on an Excel sheet? It's your own.
No, you could. I mean, that's obviously going to require some knowledge of the tax law and how to compute the contributions, and it's going to require a baseline level of, being able to keep up with some financial accounting. But I mean, there's no reason you couldn't do it that way. Yeah.
Right. So you could go as basic as that, but I feel like it's just, you're leaving yourself room for error. Why not have just someone who's, their expertise is that, do it?
Yeah.
So it makes sense.
I agree. One, in my experience, it's usually better to hire a professional to do something you're not comfortable with and do it right. But that's, everybody has their own way of doing things, I suppose. Yeah,
no, absolutely. Yeah, and also I feel like you would go to bed a lot better, knowing that your 401k is being recorded correctly. Yeah, so thank you for that. I mean, I feel like maybe we can email you for those referrals, because I get that question a lot. But so people are right now still asking a few of the questions that's specifically like, if I'm over age 62 and I do some real estate investing, and then I also am an owner of like an S corporation, do they qualify for a solo 401k? But I think there's a key thing missing there, and you probably say is like, well, do you have earned income? Are you making self-employment income?
Right. Yeah. So yeah, you have an S corp. I assume it's operating a business. If that business is paying you a salary, then you can contribute to a solo 401k based on your salary. But you know, I think it's important to keep in mind as you approach retirement age. You know, if you're 62 years old, you're going to have to start taking the money out of that solo 401k in 10 years. So you're not really getting a super duper tax benefit from having a solo 401k in place. I'm not saying that that means you shouldn't do it. I'm just saying you need to think about whether there's going to end up being enough benefit to be worth doing, I guess.
Yeah, I feel like you maybe even think about, okay, how much are you paying yourself? How much are you making? What is your contribution going to look like? Is it going to really be worth it? I mean, I feel like if you're able to, let's just say hypothetically, give the maximum that you can give to a solo 401k age 62, which I believe is like 62,500 or 63, including the catch-up contribution.
It's 58 is the standard, and then if you're eligible for catch-up over age 50, it's 64.5, I believe, 64,500.
I feel like if hypothetically you can do that maximum at age 60, you know, you still have 10 years before you take money out, kind of worth it. I mean, and the IRS also said now that you can even past 72. I don't know if the same thing applies to solo 401ks, but past 72 for an IRA, you can continue to contribute as long as you have earned income. Where in the past, it was once you reach 72 or your RMD age, you couldn't add more money in. You're just taking money out.
Gotcha. Yeah, I'm not off the top of my head sure whether that same rule applies to 401ks or not.
Yeah, but just, you know, food for thought. So one thing before we move on from contributions is also Roth contributions. So could you explain how the Roth portion of it works, where that applies?
Yeah, I mean, it's pretty analogous to a Roth IRA, except for I believe there are no income limitations. So, you know, a lot of times you are able to make Roth contributions to a solo 401k, but it depends on what your plan documents will allow. So you're going to need to sort of visit that issue as part of structuring your plan documents, or if you already have a plan in place, you'll need to look at it. But, you know, I always get asked the question, should I contribute traditional or should I contribute Roth? And the answer is, it depends. But yeah, generally speaking, that should be possible. Yeah.
Yeah. Our 401k plan allows for Roth contributions from the employee.
Right.
And also in-plan Roth rollovers. So we see a lot of people doing that as well because they want to get the entire thing. They want it all made up of Roth, right? That's the idea.
Yeah.
So they're putting in Roth contributions, and then once the employer makes a contribution, they're doing the Roth rollover, which is basically a conversion within the plan. You end up taxing yourself ultimately, and I guess really doing a lot of bookkeeping to just move the money over.
Yeah.
What's your thought on that?
I think it works. You know, when you do an in-plan conversion from an employer contribution and you're the owner of the business, from a tax perspective, you're taking money out of one pocket and putting it in the other because you have a tax deduction and then you pick up taxable income on the Roth conversion. So it's sort of a non-event. But I do think that having, you know, the ability to make Roth contributions is a great benefit, and you need to look at. So do we want to tackle the question of should I do traditional or should I do Roth? When is one more beneficial than the other? Is that something we want to talk about, Juan?
Why not? We got time.
Sure. So people ask me the question a lot. Should I be contributing to a traditional IRA, or in our example, making traditional 401k contributions, which are tax deductible, or should I do Roth contributions, which are not tax deductible? Just a quick, hopefully 60-second summary on the difference between the two. If you make a traditional contribution to a 401k, it is tax deductible now. It reduces your tax liability in the current year. Those earnings grow tax-free, or tax-deferred rather, throughout the amount of time the contributions are in the plan. And then in retirement, when you withdraw those funds, all of the amount that you withdraw from the 401k, sorry, I got a motion sensor here. All of the amount that you withdraw from the 401k is ordinary taxable income. And so it's tax deduction going in, taxable income coming out. A Roth, by contrast, when you put money into a Roth 401k, then you do not get a tax deduction up front. So you're paying taxes on your salary that you're deferring into the plan now. And then that money is in the Roth and it grows tax-free throughout the entire amount of time the money's in the account. And then it comes out tax-free. So when you withdraw the funds in retirement, there is no tax on those Roth 401k withdrawals. And so essentially, it's an arbitrage. Either I'm paying tax today or I'm paying tax in the future. And really, what determines which one of those two options is going to be more beneficial is what you expect the relationship to be between what is your tax rate now and what will your tax rate be when you retire. So in the case of what we'll call the traditional retiree, they maybe are making a lot of money right now. And then when they're in retirement, they will have considerably less income. So you'll have some Social Security, they'll have their retirement plan withdrawals, but they're expecting that to be less. So they're going to be in a lower tax bracket in retirement than they are today. This type of person would benefit more from having a traditional 401k contribution because they put the money in today and they get a tax deduction and their tax rate is 37%. So every $100 that they put into 401k, they're saving $37 in taxes today. And then when that money comes out, when they're in retirement, let's say their tax rate's 15%. When they pull that $100 out on the other side, they pay $15 of taxes. So they save $37 over here, and then they pay $15 over here. This is obviously an extreme oversimplification of how it would actually work, but I'm just trying to give an example. For the Roth, it's sort of the opposite situation. If you think your tax rate in retirement will be higher than your tax rate now, then you prefer a Roth. So, for example, if I'm not making a lot of taxable income right now, but in retirement I expect to have a lot of passive income that's going to be pushing me up into higher tax brackets, then potentially a Roth IRA Roth 401k contribution could be a more beneficial choice. I hope that makes sense.
Yeah, no, it definitely makes sense. I mean, it is the ultimate. It depends on your situation, right?
I mean, this should be taken very generally.
Absolutely.
And if you want somebody to give you an opinion on that, you should speak with your tax advisor about your specific circumstances, because it really is going to be, it could be different for everybody, depending on everybody's different circumstances.
Yeah, and I'm personally seeing a lot of people making more money now than they thought they were going to, right? In older age, so it changes. You can't foresee that ultimately unless you have a crystal ball. So,
right.
Yeah, as you mentioned, someone who knows your situation maybe to guide you in the proper direction. But that helps a lot. Thank you for that. Jimmy, I think that answered your question too. In-plan conversions, Roth triggers taxable events. Absolutely. As you mentioned, it's kind of a sort of a wash, but yeah, it does trigger a taxable event. One thing that while you were speaking, I was reading some of these questions here, and it brought up a topic that I don't even think was written down. How familiar are you with like affiliated groups as it relates to the 401k accounts? Because we get situations where people have multiple businesses, whether it be with themselves have 5 different businesses, or them and their spouse have businesses that they're a part of together, or however. And obviously, we know that with the solo 401k, you cannot have employees, right? But someone maybe wanted to establish a 401k for company A, but they have B, C, and D over here. Well, what do we have to do to make sure that we can qualify for a solo 401k?
Yeah, I mean, if you own both companies, you're probably not going to qualify. The common ownership rules with respect to 401ks are a bit complicated, but suffice it to say, if you and your spouse, or you and your direct family members own most of a company A, and most of company B, or all of it, those are going to be looked at together as a common control group for purposes of determining retirement plan eligibility. And so if you have company A with employees operating business, and company B where it's just you and you want to set up a solo 401k, and you own both, you're probably not going to be eligible for a solo 401k under company B because you have employees in your common control group in entity A. And so sort of what that ends up meaning is if you have multiple entities and you have employees in some and you own the majority, if you want to set up a 401k, it's probably going to have to include everybody who's an employee in your common control group.
Right. And another instance where kind of to talk about different companies that you might have, I've heard this before where they don't have any employees nowhere. It's just companies they have out there, but they set up a 401k under the name of I don't know, ABC LLC. But XYZ LLC later down the line, 2 years later, starts bringing in more income than the other one. Do you know if they're able to like just swap out which income they're drawing from? Does it draw from all of them since they're controlled groups?
That's a really interesting question. We can discuss that further. I don't have that answer right off the top, but if that's something we want to pursue for a follow-up, we can.
Yeah, I get the question a lot at the same kind of situation. I don't know. Right. I feel like that's a thing to dive into your own personal situation. It popped in my head as we were discussing that. So I'd ask.
Sure. No, I mean, if somebody has that specific question, they feel free to reach out and we can take a look at the specific circumstances, because I think that's another it depends kind of thing too.
Right. Yeah. Well, that's great. So let's keep moving on, trucking on here. Investing. Let's talk about investing, I guess. So obviously, can you buy real estate in a solo 401k? Answers.
Yeah, of course. Yeah.
I think the solo 401k is created to kind of, and why people seek it out so much is because of the freedom it gives you. I wouldn't say freedom, I guess control it gives you to manage those funds as trustee of the plan, have checkbook access, et cetera, to use that towards real estate. But not only real estate, I've seen people even like have brokerage accounts under the 401ks and they're kind of diversifying within that plan. Have you seen that before?
Yeah, of course. No, definitely.
So investment wise, I mean, it's a fairly superior account, but what are things that people should be looking out for whenever investing with a 401k? What are things that I guess are good and maybe bad about it?
Yeah, let's talk about pros and cons a bit, just from a very general perspective. So the good things about investing in a solo 401k, if you're making traditional contributions, you obviously get tax deferral on the amount of the contributions, and you have a deferral on taxation of the earnings during the period of time the money is in the 401k. That allows you to accumulate assets faster than you would in a situation where those assets were in a taxable account, because if they're in a taxable account, you have to pay the tax every year, and that sort of reduces your principal that you have growing over time. Another pretty big benefit that is specifically applicable to solo 401ks is that they are not subject to the unrelated debt financed income rules, or UDFI. Some of my IRA folks might be familiar with that term, but basically, you know, if you have income from a debt leveraged asset in an IRA, that's going to be taxable income, UBTI, to the IRA. Those rules do not apply to the 401k under current tax law, meaning that having a debt leveraged rental property in a 401k is not going to create an immediate tax consequence, or UBTI, for the solo 401k under current tax law. Now, obviously, who knows if that changes in 5 years or not, but it's been that way for a while. So that's a pretty big deal. In terms of the cons, you know, if you have a lot of appreciating assets in a 401k, it's worth thinking about that when that money comes out, it's going to be ordinary income. Whereas if you had held those investments in appreciating assets outside of a retirement account in just like, you know, some taxable context, when you eventually realize the gains on those investment assets, some portion of that might have been capital gain taxed at a better rate. But again, it depends. But I think solo 401ks are a pretty great vehicle for investing, especially with respect to real estate.
Yeah, I think it's hard to find a con sometimes, but
yeah,
you're right. I mean, if we're thinking about it from tax perspective, you do miss out on some things that you could be taking advantage of if you owned it in you mentioned a taxable entity.
Right.
Got a question here that they said non-recourse are the only loans allowed to a solo 401k. That's correct. That is correct. It has to be a non-recourse loan given to the solo 401k. Same rule applies for IRAs as well. But one thing, a part of this question I wanted to ask is, can funds from a non-recourse loan be used to contribute to the plan as an employer and employee?
So you borrow money from some party and you use that money to make contributions for the employee and the employer to the solo 401k. I think that's the question. I don't see why you couldn't do that. I believe that you would be able to do that. Okay. But I mean, think about who's borrowing the money. It's not the plan. The business is borrowing the money, whether that's a pass-through entity or an individual as a sole proprietor. They're taking on that debt in order to make contributions to the plan. I think that's totally doable, but you need to be careful about the risk that you're taking, because it sounds like if it's a recourse loan, you're assuming personal liability, putting yourself on the hook, right? And if for some reason you can't pay back that loan, the assets related to that loan are in a tax deferred retirement plan. And if you need to take that money back out to pay off the loan, then you're going to pay tax, penalty, and interest. And it could, if you aren't careful, I could see it turning into a less than ideal situation. So just be cautious if you're going to do that, please.
Yeah, it's like a snowball effect.
You need to make sure that you're going to have cash flow available in the business to service that debt.
Yeah. On the investment topic, still, does solo 401k work for fix and flips or only buy and holds?
Will it work? As in, can you do it? The answer is yes. If you're in the business of fixing and flipping properties, then that is likely going to be considered trade or business income, and it would be unrelated business taxable income. Whether you use debt leverage or not doesn't matter, because it's sort of an operating business activity that would be considered UBTI and would be basically taxable income to the 401k, and the 401k would have to file a Form 990T and pay income tax on that income.
Yeah, so that I'm pretty sure probably sparked some questions there. So now we're talking about, just to kind of clarify again, because we touched about it already, but I feel like I understood it because I talk about that topic a lot, but maybe someone didn't catch that. So there's UBTI, and has, I would say, a subsection to it, which is UDFI, unrelated debt financed income, which occurs whenever you take on a non-recourse loan, buy debt leverage real estate, and with a 401k, it's kind of wipe our hands clean. It's very nice. It's an exception that it has. However, there's other ways that this tax, this UBTI, can be triggered.
Right.
You mentioned one of them, that's running a trade or business. So if you are a personal flipper, you're saying that if I flip, and this is how I make my bread and butter, is how I put food on the table every day, and I start doing that within a 401k account, I can potentially, I think the key word is also potentially, end up paying a tax for my 401k for doing that, kind of running my business through my 401k.
Yeah, I would take your potentially and take it up to likely. I think that you would likely end up paying tax within the solo 401k under the unrelated business income tax rules, because basically you're running an unrelated business in a tax-exempt entity. A 401k is a tax-exempt entity, and that's what these rules were designed for. So if I'm running a business like flipping houses, like I own a gas station, I own and operate a gas station, or I have any number of things, a retail store or a restaurant or whatever, and it's an operating business and it's inside of my 401k, it's likely that all of the income from that business activity is going to be taxable income within the 401k, and the 401k is going to have to actually pay income tax like a corporation would while that income is being earned.
Are you taking like that as in constantly doing it? What if someone was using a 401k just to flip, and they flipped 2 homes in 1 year?
Obviously, there is no super bright line IRS test for at what point does an activity rise to the level of a trade or business. But I think generally speaking, the most important fact in the IRS making that determination for you is, what was your intention at the time that you bought the property? If your intention is, my 401k is going to buy this house, it's going to fix it, flip it, sell it for a profit, then the IRS would look at that and say, that's ordinary business income, taxable as UBTI. I don't think you can say, well, I only did 2, so it's not a trade or business. I think it really depends more on the intention of the activity. And I don't think that it's 1 is okay and 2 is not okay kind of thing either. I wish that there was a very bright, clear test in the IRS rules, but there's not.
I wish there was a lot of very clear tests in the IRS rules, but there isn't. We touched on the Form 990T. Explain kind of what that 990T form is and when kind of needs to be filed, why.
Yeah, sure. Form 990T is a tax return for the solo 401k or for an IRA to report the unrelated business taxable income of the entity and to figure the tax that the entity owes to the IRS under the UBTI rules. I work on a lot of these unfortunately, preparing the form involves some, relatively in-depth tax knowledge. And so I haven't really met anyone who's tried to successfully do it themselves. I think generally you're going to need a CPA to do that form for you. Yeah, but it's just a little more background about when it's due. The tax form is due April 15th, just like your personal tax return generally is, and you can extend it into October.
Yeah, I wouldn't recommend anyone to do it themselves. I don't know. That's just giving yourself a headache. But I saw a question. I think I lost it. Where is it? Okay, here it is. Using an IRA to buy real estate, we'll talk about 401k. Using a 401k to buy real estate. Have you ever heard of people paying UBTI if they have an Airbnb?
Yeah, I mean, Airbnbs are a really fascinating topic because you get into what's called the short-term rental rules, which are, fairly specialized area of the tax code. But generally speaking, if you have a rental property, which is an Airbnb is a rental property of sorts, and the average use period is less than 7 days, your average renter stays less than 7 days, then that's not considered to be rental income. It's considered to be an operating trade or business. And so whether or not a solo 401k would pay tax on the income from an Airbnb investment really depends on how long does the average person stay there when they rent it. Really interesting. So that obviously means you have to keep very detailed records of who's staying there, right? Because otherwise you won't know. Sort of a tangential issue is a lot of times when people have an Airbnb property that they're running, they expect to have some personal usage of it, which is an absolute big no-no if that Airbnb is owned by your retirement plan, such as a 401k or an IRA, because that would be a prohibited transaction, which I think we'll get into more detail later. But if that's your idea that I'm going to get this Airbnb, run it out of my 401k, make some money, and I'm going to stay there sometimes myself, you can't do that.
Yeah, I feel like we can talk about the UBTI so much, but yeah, you're right. I mean, I think like Airbnbs, they're seen as like kind of hotels, short-term rentals. I mean, it's like 3 days, 4 days, right? So that's a great answer for that. Before we move on from UBTI and UBIT, someone asked, I thought the purpose of the solo 401k was to avoid UBIT. That's not the purpose of the 401k, right? We've got to step back a little bit and remember that the purpose of it is for your retirement, in the grand scheme of things. The thing about UBIT though is one of the advantages it has is that you don't pay the tax when you take on debt leveraged real estate, right? So right. A loan. But there are other ways this tax occurs. That's what myself and Adam are talking about here. So if your sole goal is to avoid UBTI, using a solo 401k, speak with myself, speak with one of us, your CPA to discuss your game plan and really, I guess, determine, is it worth going down that route? Are you really going to be avoiding what you're looking for, or are you kind of confused on, what it is? So,
I mean, I would come right back and say the purpose of UBTI is to charge income tax on income earned by retirement plans. So in addition to other things. So I think you need to be very careful about what you're trying to accomplish. But if you're talking about with respect to rental real estate that's debt leveraged, then yes, you potentially can avoid UBTI moving from an IRA to a solo 401k.
Right. Yeah. So a whole lot of things to uncover on the UBIT topic. I feel like we don't even have that much time. I don't want to take, I want to go over. So we have about 10 minutes or so. So let's start moving on here. So you mentioned a little bit about it, the prohibited transaction, that if you had an Airbnb and it's a very nice property and, it's on a lake and you want to go there with your family, but it's owned by the IRA or the 401k account, unfortunately, you cannot use it, right? The same way you can't use cash in your IRA account to go buy yourself a home because that'd be completely prohibited. You can't have the IRA just buy the home and then you live in there, right? Or even use it for vacations. Now, I was gonna say like IRS is in the bushes, but like the thing is you gotta just know what you cannot do, right?
Yeah, I mean, if I'm representing you as your CPA, I'm not going to follow you around to make sure you don't go to your Airbnb, obviously. But it is, I mean, actually, it's illegal, right? It's illegal, so don't do that. But a prohibited transaction, if you wanted to really boil it down to the simplest possible terms of understanding what's prohibited, It's going to be any transaction where you're doing business with your solo 401k or your IRA, or you're receiving a benefit from your solo 401k or your IRA. So like you said, it's personal use of a property owned by your retirement plan, or, loaning money to your retirement plan personally so that it can purchase an asset. That's also a prohibited transaction. If your entity owns an operating business, you can't buy products from it. It can't buy products from your other business. Basically anything that would be self-dealing or a transaction between you or an entity you own, or a family member, or your plan, and your plan, then that's going to be a prohibited transaction. And obviously the rules are a little more complicated than that, but that's sort of a 30,000 foot view of, people should just kind of have that flag in their mind where if they think, oh, I'm doing this transaction, wait a minute, this is a transaction between my retirement plan and me, they need to talk with somebody about that. Right.
Yeah. And there's a question here that, can you partner with your solo 401k in a real estate transaction? Let's just say 50-50. I feel like that one is, people sometimes say, yes, you can partner with your 401k. I mean, you can, but can that also be seen as a prohibited transaction?
You actually can do that, but you have to be extremely careful. So let's say that me and my solo 401k are going to go in together to purchase some sort of investment property. We set up a new LLC, ABC LLC. I put in $50,000. My 401k puts in $50,000. We're both 50% owners of this LLC, which is a partnership. That LLC then goes out and buys a property, and it operates that property, and there's profit. Great. Nothing about that is inherently a prohibited transaction. But when it comes time to take the money back out of that LLC, like it's earned some profit, and now we want to distribute that profit to the owners. And you just need to be careful that I'm doing that pro rata. So let's say I have $10,000 of profit that I want to distribute to the owners. I have to distribute it back out 50-50 because the entity is owned 50-50. So 5,000 goes to me, 5,000 goes to my 401k. And just don't mess with it, right? Just keep everything kosher, keep everything clean, and you'll be fine. It's doable. I'm just saying you have to be very careful.
Yeah. You want to stay on the same side of the fence, stay parallel throughout the entire transaction if possible. Right.
Yeah.
There, I don't know if you want to get into it, but there's some situations that have been thrown out on the chat box and stuff where people are asking if this would trigger UBTI. Now you can say yes or you want to do it or no, and we do maybe a few, but I feel like a lot of these situations, again, it's out of the scope of this presentation, like to be able to tackle.
No, that's totally fine. I mean, we have a few minutes left, so I would encourage those people to maybe reach out to you or me directly, and we can address those case by case.
So let's do that because I feel like there's a whole lot of them, and we can't get to all of them, and ultimately that way we can focus on kind of the meat of the topic here. So if you were to get W-2 employees later down the line, as we kind of wind down here with the solo 401k, you had it for a year, maybe 2 or 3, whatever, and then you get an full-time employee year 5. What happens to the solo 401k? What do you got to do?
Right. So obviously, if you have a solo 401k, it's called that for a reason. And if your business brings on additional employees, you can no longer have a solo 401k. You have 2 options. You can either transition your solo 401k plan into being a full, regular 401k plan, including all of the employees, which, by the way, would likely mean that you need to make contributions on their behalf as the employer if you're going to be doing that for yourself. There are anti-discrimination rules related to 401ks that say, okay, owner, you can't just contribute for yourself, you have to contribute for all of your employees. That's option 1. You can make it a full plan and include everybody and make some contributions for them, and that's great. It's a benefit for your employees, but you have to look at the cost of that, right? Option 2 is if you don't want to mess with that at all, you can actually just terminate the solo 401k and roll over those funds into an IRA. And then you'll have that money sitting in your IRA. You can, put it back into other investments if you want. But then going forward, you're limited to contributing to that based under the IRA rules, which allow a smaller amount of contributions than the 401k rules generally, unless it's a SEP IRA, because we're getting into a whole different topic there. So
yeah. So it comes down to two options. So you know what you have. And one thing that came up is contributions. We use the term sometimes here at Quest. You got to legitimize your 401k account, right? We always like to say that when you're setting up a solo 401k, you want to use it for the purpose it's intended for, to contribute to the plan ultimately for the benefit of the participants.
Right.
Is there like a rule of thumb or anything like that you would say that you have to do it within a certain time frame? We say, I like to say like within a year if you can, or like from 3 years. I don't think you have to do it every single year. Contributions. What's your take?
Yeah. There is no super bright line. This is spelled out in the code. Here's exactly what you have to do, right? It's not there. But I agree with what you said, that you should be using it for its intended purpose. And I would think that that means you're making contributions within a year or so. I mean, if you don't make a contribution in the year you set it up and you start contributing the following year, that's probably fine. But I wouldn't want to just set up a solo 401k and then not contribute to it, because that looks like I'm doing this for a tax avoidance purpose rather than doing it for the intended purpose of saving for retirement and getting those tax advantage benefits of doing so.
Yeah. I think I think what the IRS does, what word they do use is intention a lot, right? They want to know your intention. The other thing too, contributions, I want to just kind of reiterate the differences here. The contribution and a rollover or transfer, they are different, right? I think my dog's about to bark, just letting you guys know, but there are a difference, because a rollover or a transfer is not a contribution. So rolling over from different IRA accounts and 401k plans, there he is. So he's barking. I think he's done. So rolling over from a 401k plan or traditional IRAs that you have into the plan doesn't, I guess, qualify you for a contribution or legitimize. I think you still need to personally put that, in from your paycheck or whatever it is, right?
Yeah. If you're not planning to defer into the plan from your income and make employer contributions into the 401k, then I probably personally wouldn't feel comfortable with that, because that seems to suggest that you just set up that 401k to avoid taxes, like in the sense of, you're probably trying to get out of the UDFI rules is what you're doing. I would not feel comfortable with that. Yeah, but again, I'm not saying that there's any specific, like, this is 100% what you have to do rule. Yeah,
I would say, just again, it goes back to the beginning. Don't put the cart in front of the horse. Have everything prepared to qualify you for proper 401k account.
Yeah.
So kind of winding down here, last two things. So you kind of mentioned it a little bit. We talked about SEP IRAs and stuff like that. Obviously IRAs and HSAs, they all have a benefit that gives you a tax deduction. How would you explain, so for going just real basic, how would you explain why that's a benefit and how it's, I guess, greater in a 401k?
Right. So, I mean, the whole purpose of having these tax advantage plans is so that when we make contributions to them, speaking of traditional, not Roth, so that when we make a contribution to them, we get a tax deduction for it. And what that basically means is that my current year taxable income, and therefore my tax, is reduced because I'm putting money into the plan. Each of these different types of plans that you mentioned, HSA, traditional IRA, SEP IRA, 401k, they all have different contribution limits. And you can actually have a few of the different plans at the same time, right? So if I'm maxing out my solo 401k, that doesn't preclude me from having an HSA. So I would say, you want to look at holistically, what are my objectives? What am I trying to accomplish? How much profit or excess compensation do I have available to defer? And then sort of prioritize where you want to put those funds. I do think that prioritization is probably outside of the scope of today's discussion. But suffice it to say that you can put a lot more money into, say, a solo 401k or a SEP IRA compared to a traditional IRA, if that makes sense.
Yeah, it does. No, definitely. And then who's taking that deduction ultimately? Like, I think in a 401k, that's also a misconception. Who's kind of taking that deduction? If you have like an employer, if you're pay yourself a salary through your pass-through entity, is it the entity taking the deduction? Is it you?
So the employer portion that the employer is contributing on your behalf is a tax deduction at the entity level. The employee deferral portion, deferring from their salary, the employee part, is reducing their taxable wages. And so that's not actually a tax deduction per se on their personal tax return so much as it is that their amount of taxable wages is already reduced on their W-2. Now, the employer taking the deduction for the employer part of the contribution reduces the employer or the operating business's net income. Assuming that you have a pass-through entity, such as an S-Corp, or maybe it's a sole proprietorship reported as a Schedule C, at the end of the day, that means you're going to have less income reported on your personal tax return as the owner because the business was able to take a deduction for the employer portion of the contribution.
Yeah, that was beautifully said. But yeah, as we close out here, so any last remarks? I definitely want to make sure that you're able to put your contact information in the chat box for everyone to, I guess, have whatever you prefer them to contact you by. And again, guys, remember that you can also watch the replay of this on our Facebook page. A lot of the questions, there's still a few that we couldn't get answered. I think that they may have been answered indirectly just through the conversation. But if you guys have anything that you really want to, ask Adam, I feel like, do you mind just sharing some bit of information and last remarks?
Absolutely. With respect to the contact info, Nicole, do you want me to type that in somewhere? Or are you gonna put the link in? Just let me know. Okay. Yeah. So the best way to contact me is usually via email, especially if you want to email me with some opening details about what your question is, and that's going to be barr@mgallp.com. And that's the best way to contact me. I tend to get flooded with emails after these presentations, so it might take me a couple days to get back to you. If email is really not your thing, you can give me a call, 713-982-7820, and we can chat through it. If you email me a complicated question, I might just answer you and say, let's get on the phone as well. But anyway, that's sort of how you can contact me. With respect to closing remarks, Juan, I just wanted to say something in the commercial you showed at the beginning really rung true for me. My general advice that I would give to you is if you're going to invest in something in your solo 401k or your IRA, make sure you're investing in something that you understand. I think that's very important. If you want to invest in real estate, take the time to get a little education on how it works. Make sure you understand what the tax implications are. Make sure you understand what your reporting requirements are and how to identify what's a good investment and what's not a good investment. Just take the time to make sure you're investing in things that you understand. I really did enjoy speaking with you today, Juan. It was a great time, and I'm glad that we got to have a conversation. I hope we do it again sometime.
Yeah, thanks for taking your Saturday or a little hour of your Saturday with us. I hope you drove to the office. I don't know if you used that bike or not, because you're in the Heights and I'm in the Heights, and it started pouring just now.
Oh, no, I walked through it. I walked through some rain on the way here, but it's fine. I live like 1,000 feet from the office.
Oh, awesome.
Yeah.
All right, man. Thank you for your time today. You enjoy your weekend. Thank you, everyone, for joining us. Again, the replay on our Facebook page. Any last questions, this information's there. We'll leave the chat box open for a little bit after we log off, just so you guys can get information. And see you guys, next time. Thanks, Adam.
All right. Thanks, guys. Bye.